So welcome to our little conference, the Rise of Institutional Investors. We are a very small crowd, and we always thought that we have no idea how this will turn out, opening a new door in our history. Our name is European Association for Banking History, and today we don't talk about banks. But the reason why we started thinking about it results from a discussion, me and Harold James talking over dinner, what really happened in September 14th when Lehman collapsed. And for me, September 14th was a fantastic dinner in Cap d'Antibes with the central bankers of Europe. We had a villa, so Christine Lagarde was there as then finance minister. I was on a table with other central bankers. We had an opera performance in open space, and life was really good, except that everybody's cell phone continuously went off, and nobody switched it off. So people were constantly, excuse me, everybody pretended nothing is going on. Everybody was on the phone with their people in the United States or whoever had to make a governance decision. So actually it was I. I went into that wonderful evening where we could see the stars over the Côte d'Azur just after a briefing with my chief executive of North America, Seth Watt, who represented Deutsche Bank in the Federal Reserve, and actually was part of that final meeting where Federal Reserve and US Treasury officials plus the banks by and large decided. Of course, the formal decision was with the government, it was not with the banks. But what they did, so they went around all the banks and said, what's your position? That's the reason I had this chat with Seth Warden. I can't remember the exact figure anymore, but I knew that if Lehman Brothers collapses, that I would make 240 million of profit out of short positions that we had, because I had carefully shortened. I was the risk manager at that time, carefully shortened it, and I also knew that I would make money out of Merrill Lynch, out of Morgan Stanley, and all the others, because we were structurally short the entire financial sector. So that's what we reported. And Seth Watt told me later, I wasn't in this room, and everybody around the table said how it would pan out. Everybody reported the same. So the Federal Reserve that was under depression. Okay, the big banks, they're all short, everybody's going to make money. This is the time where we have to let it go because the damage will be limited. Susan Wegner, who was the chief operating officer at the time of BlackRock, and a good friend of mine, told me later, you know what, we institutional investors, we were never invited to this conference room. So on Monday, so the thing happened, remember the headlines, so everybody is nervous, we manned the desk, I was then back here in London on Monday morning, nothing happened. Yeah. So towards 4 o'clock, so we started to congratulate ourselves and saying, hey, I think we did something well, because the banks traded with each other, everybody knew that everybody was short, and life seemed to be okay. Monday at 4 o'clock, until Kevin Parker, who was the head of our asset management division, called me and said, Hugo, they broke the buck. And I had no idea what he meant. And then I said, the US money market funds, the mutual funds, they had now values below par because they put in hybrid securities from Lehman in order to beef up the return. So the value, the mark-to-market value of their securities was below par, and by law they were obliged to have them par. And therefore, this breaking the buck means you break the dollar. It's not 1-to-1 anymore, but it's 1-to-0.97. And the US government had to rush in and cover all the mutual funds with a guarantee. That's the first time ever that an institutional investor showed up in this crisis. And it tells us that we totally missed the boat. We totally missed that the key elements in today's capital market structure are not the banks anymore, but are the institutional investors. And that's the reason why we have this conference here. But the key thing is actually this chart. Yeah? So when you look, so in total, it looks like institutional investors and banks, by and large, grow at the same pace. But that's actually not the case, because institutional investors are primarily in the United States and in Europe, and in Europe in only a few countries. So it's the UK, it's the Netherlands, and it's Switzerland, a little bit of Scandinavia, that's it. So otherwise, the institutional investors, like in Germany, they don't play a big role. But they're not in Asia. In Asia, they're not big. And in Asia, the bank grow because the state and the capital markets are not developed. But just look at that chart alone. So that chart tells you that the biggest growth in money under management happens today with institutional investors. So that means they become the biggest player in the whole thing. Now, when you look at this, so that tells you even more. So that shows you the composition. So you have in there mutual funds, you have in there pension plans, you have in there insurance company, you have in there sovereign wealth funds, and the amount of money that they manage is truly staggering. So we are today at 140 trillion. And what that means is that you have now on this amount of money, you have professional managers. These are not individuals. These are people who base their decisions on analytical tools, on computer programs. They are on the regulations or whatever the regulation is, but these are professionals. These are not individuals who decide by themselves. And what is even more astounding is this, how the whole thing shifted. So when you go back to the very beginning of 1945, private individuals controlled the wealth of, that's what we tend to think. Yeah. Rich people control the world. When you listen to the political debate, there's only the fat cats and all that. But that's not the case anymore. So actually, our society is owned by ourselves, because the mutual funds are our savings. The insurance company, these are our life insurance policies. And the pension plans, these are our retirement savings. So it's basically, we own ourselves when you think it in a very structural way. So the public owes the wealth of the nations. And that's very, very important implications why we need to talk about it. So if the statement is true that they are the biggest mover in capital markets and the public owns them, so we need to define how the public runs these funds. So how are we represented? How are we going to make sure that the money has a decent return? The effect of the institutional investors getting bigger was even accelerated through the crisis, because one thing that happened in the crisis after 2008 is that banks were forced to delever. When you add up the inventory that banks had in order to trade, so of the 140 trillion, so the bank's inventory was about 7 trillion. That's a number that barely anybody mentioned. Deutsche Bank had 650 billion trading inventory on the 1st of January 2006. No, 2007. So we had 650 billion of inventory. So to enable trading, that because of capital requirements and liquidity requirements, that shrunk massively. But that didn't just evaporate. So that's now with different owners, and these different owners are the institutional investors. And you can clearly see that credit assets, which were very much on the balance sheet of banks before the crisis, they are now also owned by institutional investors. So they dominate the entire spectrum. They own, by and large, the shares of this world, by and large, the government bonds of this world, by and large, the credit assets of this world. It's truly impressive. What's even more impressive is that we always talk about banks in the newspaper. Does anybody talk about mutual funds? Usually they don't make headlines. And when you look at how they are organized, there's no association like the IIF of the banks, which pools the interest of global banks. That doesn't exist. So you may know about BlackRock, or you may know about Vanguard, or Fidelity, but these are individual things. So the rest is very, very fragmented. Another things that had boosted the institutional investors since 2008 is the very accommodative monetary policy of central banks. So you all have saving accounts and checking accounts, and when you are an unlucky Swiss, that costs you today 0.75%. So the privilege of having a bank account means you need to pay the central bank money. If you're unlucky European, it's 0.4%. If you're in the States, you get a little bit more, but you get no return. And the return is somewhere else. So that is deliberate policy. So the central banks, with quantitative easing, wanted to push everybody into more risky assets, and that's what they did. So there we ended up, and these risky assets were actually bought. So in a nutshell, what does that all mean? So it means that what started as capital markets which were controlled by private individuals are today no longer controlled by private individuals. They are now firmly in the hands of professionals. And these professionals, they have a job to do, and they do it in a very structured manner. And we need to debate a little bit how do they do it, because they affect us to a great extent. I'm going to the histories of where all these things are coming from, so that you get a little bit an overview, but the key question with institutional investors remains, so how do we as society govern this huge amount of money, and what aims shall it be used for? Pension plans is something that most people know because we benefit from it. We have one. It's now common standard. It wasn't always like this. So the first pension plans, company-based, come from the United States. They date from the end of the last century. There are very few. It started to grow, that business. Then after the First World War, it expanded a bit. So several countries like the United Kingdom and Germany, they went on pay-as-you-go schemes for age insurance, and they deviated from it. The UK has since then returned. Germany is still on a pay-as-you-go. Some countries have their pension plans inside the balance sheet of big corporates. Others, like the Dutch and the Swiss and the English, it's outside in special legal entities. But the biggest pension plan market is today in the United States, in the United Kingdom, in the Scandinavian states, in the Netherlands, and in Switzerland. These are the huge markets, and they are established by law, and these are very, very big firms who dominate where this money is allocated. And everybody, that's the buy side, everybody caters for them. So all the asset management firm, be they called Lombard-Odier or Schroders, they go to this company and say, we have this investment strategy, we propose that you do this and this, we want to have a mandate, that's how you should run your money, and then you get the mandate for about 5 years, and then after that it's reshuffled. But it comes out of the history that I described here. What is important is that the 70s actually has seen that these pension plans get now structured. So it's the ERISA funds in the United States, it's the Swiss pension fund law that came into existence, it's the Dutch, so then they started really taking off. And these pension plans, for instance, in Switzerland, they have huge contribution. Me at my age, so I'm just above 60, so I pay 10% of my salary in that pension plan. That's a big contribution. And the pension plans, they are accumulating more and more and more money, and we have all this structural problem that luckily, thanks to medical research and progress, we always live longer. In the pension plan of Lombard-Odier, which I help to manage, our cohort of retirees gets every year 6 weeks older. Every year 6 weeks older. That doesn't come for free, so that means they have 1.5 monthly payment more on average. It's beautiful, so that everybody, but it needs to be financed, and this has big policy implication. Insurance companies go back to the time when people were able to own property. Before the rule was established and land registry were there, so there was nothing to insure. So if you were not the owner of your house or your farm, but it belonged to a noble and it burned down, that wasn't your problem. But once you own it, so you have a catastrophic loss in your life, so you want to insure it. So the first thing that happened is actually fire insurance and insurance for trading. And these things are often done by merchants and often done by people who also manage private money. When you look at who founded actually big insurance companies, quite often those are private bankers and people who trade. So that they come up with these things. And then it went into all aspects. Today we have a very diversified insurance industry, and this insurance industry does life insurance that we understand, fire insurance, they insure your car, accident insurance, you can basically insure almost anything if you go to Lloyd's, so that's what they do. But the premise is you distribute risk amongst many people so that you can save the one who has these spikes in risk that you couldn't absorb. And of course, all that is not foreseeable, so the premium, they always end up first on the balance sheet where they are managed, and when needed, this balance sheet gets liquidated to make payouts. So the insurance companies were the first who had to manage money because they had to keep it. The insurance company does not know when a payment is due. The insurance company does not know when Hurricane Sandy is going to hit the United States. So but everybody knows there are hurricanes in October and November. They are predominant and they will happen, but you have never an idea when they will happen. So you need to keep big cash funds. So they were the first to become institutional investors, and they control today 24 trillion of global assets. 24 trillion, just to give you an idea, that's about 40 times the GDP of Switzerland. And Switzerland is not poor. No, just 40 times. That's amount as your statement, your bank statement wouldn't even have enough space to put these zeros, so in order to give you an order of magnitude. The same thing happened with mutual funds. So in America, because stock trading was difficult and expensive, and even when I started my career, stock trading was very expensive. So as a young man entering Credit Suisse, I decided I need to buy shares. And before I knew it, I was 3% down because I had to pay stock exchange fee, the security account fee, and then courtage fees, I can't remember. But I basically had lost the dividend in my first year and earned nothing on these shares. So today, that costs nothing. It's very important. And in order to split these huge costs, mutual funds were put together. They started to grow slowly, then they had a crash in the big depression because people lost so much money, had to liquidate them, they had losses themselves, and they only took up then in the United States, and they basically started to take off once the technology was there to support them. We forget how fragile the infrastructure was. So our bank in the 50s made a lot of money by doing price curves of Swiss shares manually. That's the reason why we bought the first computer in 1958, because that couldn't be done otherwise. Today, we look at price curves and think they're always there. They were not there. So we had no idea. So it had to be developed first. And that was developed with computer design. And then sovereign wealth funds are a function of the oil boom. So after 73, after the Yom Kippur War, when the first oil embargo came and oil price started to spike, so suddenly they had lots of wealth, and the Kuwaitis were one of the first to build it up. Now that's a big player in the market. So the Norwegians are one of the biggest. The idea is don't spend the oil money now, save it for the next generation and invest it so that you have generational transfer, but they are big players. Now, what drives these things? So just very schematically, what drives institutional investors? So in the beginning, after the Second World War, it was just growth. The world started to become richer. It was rebuilt, and their wealth was accumulated. So people had excess savings. They started to put it into pension plans. They bought life insurance, and they bought more mutual funds. But then in the 80s, in the late 70s, 80s, something very important happened. And what happened was that we had three forces which accelerated the whole thing. We had computation, so the personal computer arrived. we had telecommunication, that you could pump data around the globe, and we had deregulation. That accelerated the growth of these mutual funds. And I'm going to show you why that has been accelerated. And then after that, so it's then the big financial crisis, which gave mutual funds a much more dominant role in capital market, because the banks were forced to retreat under the new capital requirement that they had. So economic growth, but I'm just saying this again, so because most people tend to forget that. Economic growth was a function of America winning the Second World War. People forget today that in 1946, America had just one division left in Europe. So they came to Europe with 80 infantry and tank divisions, and they had one division left, and everything else was nuclear. Their deterrence was nuclear bomber fleets, because they thought, we're going to win anyway, so why on earth would we then invest so much in infantry? And all these young men, they were surfing, they came back. They went to college. There was a program called a college training program, and when you surfed, you got a free college education, so they had suddenly a highly trained workforce, and they converted all this factory into consumer goods, and life was really, really good in the United States. In the 50s it started when all the technology started to happen, so the households were mechanized, dishwasher, washing machine, vacuum cleaners, you had your car, you had your own home, and then people went to the suburbs, all that happened at that time, and of course so that happened, that triggered also saving schemes, which were things that the highways were built. Who remembers today that the interstate highways were built by President Eisenhower, who as a young lieutenant drove a truck convoy from the east coast to the west coast over non-existing roads, and it took them an entire month. So he would never forget that. And once he was president, he built the interstate highway because he understood from his war fighting how important infrastructure was to the running of an economy. That is also very important. It shows you the volume and the price of share trading. That's the sheer impact of technology. And the only thing that you need to take away from this chart is today, trading security costs nothing. So the first time in our life, we can do something which you could never do. Me as a young man, if I didn't like the Credit Suisse stock, I couldn't get out because I had just lost 3%. So therefore I had to stick there for 2 years. It was buy and hold, and I was forced to do it because I couldn't afford the trading fees to go into a different stock. It's not the case anymore. So since we have that, we can pursue strategies because shifting the portfolio composition costs nothing, and therefore we can actually adjust the portfolios. We can maximize its return, we can minimize risk. As the world changes, we can adjust portfolio, and the transaction costs for doing this are very, very minimal. So that's sheer technology. Another thing is this, who talks about fiber optics cables? So usually nobody, because we take advantage of the infrastructure, but we don't really know why it works. It's the same way that we sit in a car and switch on the engine. So does anybody understand how a car engine works? Of course not, so we still use it. That's the backbone. That's the reason why we can deal. That's the reason why we can, without transaction costs, buy American securities, because it's within speed of light, and 98% of all the communication in the world goes through glass fiber optics and not through satellites and all that. With no delay, you can manage now portfolios on a global scale with no transaction costs. That's what it is. And it's only possible since the 80s. That's the reason why we can deal in Japanese stocks and in Chinese stocks and Latin American stocks. That's why we can have emerging market exposure. Otherwise, it wouldn't be possible because we couldn't link the whole thing together. And that's also the reason why you have mergers. So for when I started my career, so the Zurich Stock Exchange was really separated from the London Stock Exchange. Today, that's not the case. So you can compare prices. Who talks today about ADRs, American Deposits of Receipt, a stock from another country that's listed in the United States? Almost nobody anymore, because you don't need it. You can buy it directly, and this infrastructure links everything together. And then deregulation. So we have here the Big Bang in London in 1986. So some of you, I heard this morning, were talking about it because we were all affected and impacted, benefited from it. London without the Big Bang would not have started. It's very simple, because then everybody came in, and that's today the reason why it's the bigger financial center as New York, needs to be said. So London is a bigger financial center than New York. That's why London is so cosmopolitan in its nature, because it attracts so many individuals. But it's the deregulation of the area of Maggie Thatcher and Ronald Reagan that we have, and you can see what all has been done, so how Europe has been unified by the Maastricht Treaty, freedom of services. So today we think it's completely normal that you can issue a mutual fund under UCITS rules in Luxembourg, and you can sell it everywhere in Europe without further impediments. It had to be created, because these laws did not exist. And today Europe is a deep market where you can do things like this, so these things have become very easy to pursue. So what does it all mean for the capital market structure? And that's a debate that we hope to trigger, because it's one of the most important things. What does it mean if we as citizens own the wealth of this? So what does it mean, for instance, in terms of sustainable investment? Because we are investing in the future. So a lot of the stuff that we're investing is not for our generation, it's for the next generation, so they can insulate ourselves, for our social networks. So what policies shall we set? Shall we be like CalPERS, the Californian pension plan for public employees who are in activist roles, who say we want to change, we want to have sustainable investments, we want to have this? Or are we going to have purely return-based? When we go for purely return-based, what does it mean? So are we going to in the equity? Or are we going to insert? It has big implications. If the pension plans as a public institution under laws have investment guidelines like they have in Switzerland, which says that the bulk of the stuff has to be invested in fixed income, that means less capital is available for innovation. And innovation is only financed through equity, because equity is the risk of society. Now, if we are the owner of the risks of society, what does it mean? Where do we want to have the risks? Can we risk manage insurance companies or pension plans or mutual funds the same way we can risk manage the banks, which basically have been delevered a great deal? Or would that have unexpected consequences? That's a debate we have to have, because Solvency II is going in that direction. So if insurance companies cannot take risk anymore because they are not allowed under investment guidelines, who is going to take these risks? It's a big question that we need to ask. The second thing is, what are the implications on these policies on us as citizens? So what do we expect out of this? So out of these arrangements. And the last one, and that's equally so. When we think about what we are going to do with our future, so how do we want to structure the returns from it? So is what happens right now that nobody wants to work longer, is that something that is acceptable? So a pension plan, for instance, has only 3 levers to manage and to deal with the fact that we're getting older every year. So you can either take more risk, or you can work longer. So that means the payout period that until we pass away is shorter, or you can increase contributions. So far, this whole thing has been fudged, because usually companies like my company, they contribute more, so therefore the question doesn't have to be asked, but that doesn't last forever, so we will have to say, so what is it? So how do we structure our life? We cannot become healthy 100-year-old and retire at the age of 65, because we're going to tank our pension plans if we do that. And when you look what happens in the United States, it's already a big issue. Or when I look at the unfunded pension obligations in Germany, that's a big issue. So Germany's GDP debt to GDP is currently in the range of 75%, great number. But if you put the unfunded pension obligations to it, then it's above 200. So is that going to last? We need to see, but that's stuff that we need to debate. We hope that's a beginning. We hope it's a new chapter for our association. I'm very grateful that we are here. I'm very grateful that some of you had the courage to present their papers, and I hope that we are able to trigger interest in this movement and trigger interest in what institutional investors do. I personally believe that's one of the key questions that we need to address in society, and I think that is a good time to launch this debate.
I found it very interesting. One question I have is, given all that is happening in a number of countries, whether it's populism or tendency to lean towards more socialistic maybe ideas, what does that mean for capital markets, which might be seen as anathema, particularly when it's perceived that decisions made maybe now or even in the past are just helping a certain group of people, maybe the 1%, and that not enough is given to the populace to understand that the power of financial engineering, whether it's to retire well or that social safety net that these institutional investors, faceless though they might be to many, makes a big difference. Yeah.
Well, I think it's a very, very important point, but state pension plans are as faceless as institutional investors. So we will have to have a really solid discussion again, so what it actually means. So I think our citizens don't engage in pension planning, in retirement planning, so most are really surprised when it happens. We are facing a crisis of big proportions in the United States that the baby boomers are getting into retirement and they are poor. Just think about it. So you worked your whole life, you put your money away, and you wake up that you are poor. What does that mean politically? And I think we already see it in the United States. And that will cause us big, big problems. So we need to have this debate. So what is the right pension? We know that the pay-as-you-go schemes that we had, they went bust because we have this change in demography. So as long as we were a nice triangle with lots of young people supporting few older, that actually worked. But now it's inverted and it doesn't work. So we know that today about 4.5 here in the UK, about 4.5 working people support one retired person. In 20 years, this will be 3-to-1. So that means that the current generation, anything that's pay as you go, will be bankrupt, cannot save anything for themselves, and at the end they have nothing when they retire themselves. That is not a viable solution, and that will create a generational fracture in our political system, which we need to talk about. And I think, therefore, that's very important that we all understand the dynamics in these sectors.